but I'm buying index in the US. Now, what is the reason for that? It is fairly simple, that Nasdaq or S&P 500. Hi everyone. So if you study the stock market returns from 2012 all the way till 2021, you will see that the stock markets grew quite rapidly. One of the prime reasons why that happened was that the interest rates in the economy continued to get cut during this entire phase. You can observe this from this chart as well. This is the period 2012 and this is the end of 2021. The interest rates were generally cut in the economy and this led to a direct growth in the stock market. Now add to this the second phase, which starts from end of 2021 all the way up until now. During this last 1 year, the stock markets have done fairly badly. And again, during this phase, the interest rates have continued to rise. There is a very strong correlation between the cutting of interest rate and the growth of the economy. Now you would say that, okay, this is a basic macroeconomics fact. Why should I get worried or why should I get excited about all this? It hardly makes a difference. Well, you should get worried because RBI has given a very negative commentary on its recent Monetary Policy Committee report. So you can read the commentary here, and this is what they have said in essence, that the global economic outlook is skewed to the downside. This is not very positive commentary. So on this video, I am going to help you understand three critical things. So first and foremost, I will help you better absorb the negative commentary issued by RBI. Is there something that you should really worry about? There are some negative points. I will talk about that. Second, what is RBI's plan and is that something that they can execute and can they save the economy? This is two. I will also help you fundamentally understand how RBI exactly moves the stock market. Third and finally, I will talk about your limited options as an investor and what is it that I'm doing in the market right now. I am not buying a lot of stuff. I will reveal the reason for the same. On another note, if you enjoy this type of macroeconomic analysis, do consider subscribing to this channel. It would allow these type of videos to reach out to more people. I will teach about these topics fundamentally. A lot of research goes into preparing these videos. So your support will matter a lot. So let us kickstart our conversation. And first and foremost, let me show you some data points from the Monetary Policy Committee report meeting and highlight some macro aspects around it. So this is the first graphic and you can clearly see that RBI has said that the real GDP growth is projected to be 7.1% for Q1 of 2023 and only 5.9% in Q2 of 2023. Now, are 7.1, 5.9, are these like good rates, bad rates, given the Indian macroeconomic circumstances? So let me help you absorb this data better. Now, in the extensive growth phase of the Indian economy, when the Indian economy was growing at a very rapid pace, the world was also moving fast. So that helped our economy grow fast, no doubt about that. So during that point in time, Indian economy was growing at roughly 8.5% growth rate. So that is the growth rate that is considered to be good for a country like India. There is no set definition here that it should be 8, 9, 10, 12%. But generally speaking, if we have a GDP growth rate of 8.5%, that is considered usually to be good. But the commentary right now looks slightly pessimistic. This is a chart that was issued by RBI. And what they have said is that there is a 70% chance that we will grow at less than 7.5% GDP growth rate. So this is a fairly high estimate, which categorically points to the fact that our growth rate is not going to be very impressive in the coming year. Now, is it India's fault, current government's faults, etc., etc.? I am simply talking about data. I don't think this is anyone's fault. It is just that the world's growth is slowing down and India's growth will also slow down with it. Now, usually in a country like India, which is very hungry for growth because we have a young population, a bunch of other different things going for our country needs to grow really fast. So from that perspective, India requires a lot of investment. So what is it that RBI has said when it comes to investment activity in India? So they have gone on to say that the investment activity will moderately pick up. There will be moderate expansion of investment activity. This again is not a very positive commentary for the year 2023. Now, is there any good piece of news that has been issued by RBI? Yes, and it has to do with inflation. And I've been saying for the last several months that inflation will slow down. It is already slowing down. In the US, it has come down. And in India also, it is moderating. Now, one of the prime reasons why inflation slowdown in India has happened quite aggressively is because of the fact that the oil prices have come down. You can see it from this chart that the oil prices went up quite aggressively all the way from 2020 to 2022 and now they have started to come down. They have been coming down quite aggressively throughout the year, but now they have mellowed down quite aggressively. The worrying part here is that the forecast tells us that the oil prices is not going to go down further. Now, since India is an oil import country and there is a lot of energy requirement that India has, which means that inflation in India from this point, it is not going to come down aggressively. Yes, it has come down, which is good news. It is at a manageable level. It will continue to stay there, but it is not as if that we will move to a very low inflation. So this is the mixed bag of commentary that RBI has given. Now, should you get worried? Should you not get worried? Okay, so there are two schools of thoughts here. So number one, that there are some macro issues, but they will get solved with time. These macro issues always get solved, and this time also it will get solved. But there is a much bigger problem at play, and that problem has been wonderfully explained by the CEO of BlackRock. For people who do not know what BlackRock is, so BlackRock is the biggest asset management company in the world. So when they give commentary on any type of investments, we need to take it seriously. So this is a statement by the CEO. Just hear it and then I will explain it.
And so I believe after we get out of this real spike in inflation, we're going to be waking up to a world that's going to be a 2-ish, 3% world with maybe 3 or 4% inflation. And I think that's going to be the fundamental issue that we're going to be.
So basically he says that in the time period 2012 all the way till 2021, we existed in a low inflation, low interest rate type of an economy. This was completely controlled by central banks. I will explain that in a minute, how that exact mechanism works. But this entire macro dynamics was managed by central banks. Now we are moving to a phase, or rather the world will move to a phase where there will be moderate inflation plus moderate interest rate. Now this is very hard to manage for any central bank. Now, in order to better help you absorb this commentary, let me quickly explain how RBI or any central bank controls its stock market. Now, RBI controls something called as the repo rate. Now, repo rate is the mother of all rates. For example, when the repo rate goes up, it increases your home loan rates. It increases your car loan rates. It increases your FD rates. Any kind of loan in the economy will witness a higher rate if the repo rate goes up. And opposite is the effect if the repo rate comes down. So there are three types of situations that can exist in an economy in terms of its repo rate or interest rate for a countrywide level. Now the first scenario could be that the interest rates are extremely low in the economy. Now if that is the case, for example from 2012 all the way till 2021, the interest rates continue to get cut. Now again, please take a look at this graph. You will see a general decline in interest rate. So this was a low interest rate environment, and during such phases what happens is that as the interest rate gets cut, the credit flow in the economy improves. The lower the rates, the more the credit flows through the economy. The more the credit flow through the economy, the higher the stock markets will go up. Now that is a simple rule that is followed anywhere in the world. Now situation 2 could be that the interest rates go moderate, they don't go low, they are somewhere in the middle. Sometimes it goes up, sometimes it goes low. That is what the meaning of moderate here is. Now during such time, there will be a moderate flow of credit. Again, please refer to the earlier section of the video. There was a very interesting statement that was issued by RBI that next year the investment credit growth would be moderate. Now opposite happens that if the interest rates are high, for example for the last 1 year, the interest rates have been climbing up. They are going higher, higher and higher. So what that leads to is that it leads to a lowering of credit flow in the economy, which brings the stock markets down. Now RBI from time to time, they get together and they decide on this interest rate, what that prevailing interest rate in the economy should be. And for the last 4 meetings, they have been increasing the interest rate. Going forward, this interest rate is going to mellow down. It will moderate and it will stagnate somewhat. But it is very unlikely, as per BlackRock CEO's commentary, that this interest rate will go low the way it used to be from 2012 all the way till 2021. And this presents a very challenging circumstance for any central bank to accelerate growth in the economy. Now this fact can also be checked by looking at the interest rate projections in the Indian economy, and you can see this from the chart that for the next year the forecast has been moderate interest rate, that we will stay somewhere here. So this is what the interest rate forecast also tell us. Now there are a lot of people who would say that, you know what, no, I don't agree with this type of mumbo jumbo regarding rates, increasing the rates, decreasing the rate. It keeps on happening. What's new with this? This always happens. Yeah, I don't believe in it. So here is a very interesting case study about Japan, and let me talk some numbers. So you can see it here that between the time period 1975 all the way till 1990, the Japanese stock market roughly gave a 10 times return. I'm not talking 100% returns. I'm talking about 1000% return in a 15-year time span. Now this was considered to be golden era for the Japanese stock investing. But data point 2 is that between 1990 all the way till now, so almost 30 odd years, the Japanese stock market has given negative returns. Now, if I ask you the question that why has that happened, the answer again lies in the dynamics of interest rates and inflation. That Japan right now is a low interest rate, low inflation country, and therefore their stock market does not do much. Government there has made a conscious choice that we are going to keep the interest rate very, very low and nominal, and also we are going to control the inflation in the economy. Why have they done it? Simply because of the fact that the Japanese demography is older. People there are generally older. They are not working, mostly they are retired, and therefore they can't afford high inflation in the economy. And also, if they are borrowing money, they should be getting at a reasonable amount of price. So therefore, the interest rate and inflation is managed in a certain way by their central bank. Similarly, in India, that going forward, it will become very, very likely that we will become a moderate inflation, moderate interest rate type of an economy. If you are still pessimistic about my commentary, then please hear this section very carefully as to why RBI might find it really, really tough to accelerate our economy at a very rapid pace. So there are two reasons why any economy can grow. One is called as the real growth rate, and the second is called as monetary policy infused growth rate. So what is the meaning of each? So let me give you a couple of examples to help you understand that. For example, when the human population shifted from hunter-gatherer society to an agriculture-based society, there was real productivity improvement. When the human society shifted from manual labor more towards industrialized workforce back in old England, that led to a real productivity growth and real expansion of GDP. The last leg of this real productivity growth has happened because of human population increase. That the world over the last 50 years has been relatively peaceful, the population has grown and our productivity has increased because there are more hands that are contributing to the increase of GDP. So all this could be categorized as a real growth rate. But unfortunately, post 2008, we have started witnessing something called as monetary policy driven growth. Now what exactly it is, I had already explained you. This is manipulation of interest rate by central banks, and Ben Bernanke for this year had been given the Nobel Prize for Economics in order to come up with its financial innovation where you can just simply change the numbers in order to show some kind of GDP growth. Now this system was great because we could move to a world with 0% interest rate, but right now the problem in the world has happened is that the central banks now, they have all been pushed to increase the interest rate, and it is not going to be easier, at least for the next few years, to bring this interest rate down back to zero or at a very low level. So this is the real struggle that RBI and other central banks are witnessing, that there is no easy real growth left in the world, and now they have exhausted this option quite extensively. So going back on that growth bandwagon is not going to be that easy for central banks. Now what is it that you and I as investors can potentially do in order to safeguard our investments? Because the idea of this macro video is not for me to scare you, but to educate you more so that you can adjust your investment style accordingly. So there are 4 specific key takeaways that I will leave you with. Point number 1 is that it is critical that you invest because we will be in a moderate inflation environment, which still means that if you're not investing your money, if you're just putting it in the savings bank account, the inflation is going to continue to eat your money. Now comes the second and very important but yet a little bit complicated point, that cash is important. Now you would say that, okay, you're talking about invest your money, but on the flip side, you're saying that hold some cash. No. Cash is good for opportunities. You must understand phases where cash will be important. For example, right now, I feel that doing some FD makes sense. Why? Because you are getting almost 7% FD returns. You can lock in these rates for the next 2 years. It is very likely that the interest rates will get cut. Why? Because we are in a high interest rate environment right now. It will come to moderate levels, as I was explaining. So it makes sense to preserve some cash when it comes to exploring opportunities. So you must have some cash ready with you to deploy whenever the opportunity presents itself. Point number 3 is that you must understand what complex investing is. Because investing in a high interest rate environment is okay, you can do it. In a low interest rate environment, it's fairly easy and anyone can make money in a low interest rate environment. But when the environment is moderate, that is where major confusion comes. If you don't trust me, go and read the comment box. People are just looking for stock recommendations, and all those people are going to take massive losses in the stock market because they would not understand when it is the right time to do bulk investments. For example, when the Nifty was trading at 15,000 levels, it was a great time to buy Nifty in bulk. Now you would say that, okay, why are you doing like post-mortem analysis? There is is no point. You did not do it. No, I did it. Please go and check my videos. I was one of the very few people who was buying Nifty heavily during that entire phase. I'm not investing anything in bulk in India as of now, but I'm buying index in the US. Now, what is the reason for that? It is fairly simple that Nasdaq or S&P 500 still is trading at a massive discount in the US. So I'm buying there in bulk. I'm not buying anything in India. I was buying quite aggressively in India a while back, but I have stopped doing as of now. Now, the final takeaway is that you must understand assets which are overvalued and undervalued. Now, this is a very, very difficult skill to cultivate. It requires a lot more experience. I keep on giving a lot of commentary on the member YouTube section. If you consider it to be worthy, you could consider joining it. But in case you are trying to make these decisions on your own, please do not buy anything when you feel that it is overvalued. It is very unlikely that we will move to a very low interest rate environment, which would mean that if you are stuck on a hyper overinflated asset, it might take you years and years to get out of it. So please avoid buying anything when you feel it is remotely overvalued, because we are not going back to a low interest rate environment anytime soon. And if you get stuck with bad assets, it can derail your entire investment portfolio. So I hope you enjoyed this macro discussion. Do press the like button and I will see you soon.